Okay, we are ready to stick it to the life insurance industry. And I mean stick it good. Because this is where we pull the cover back. That the insurance industry is hiding behind. This is where we unveil the Wizard of Oz that, who's fooling everybody and ripping them off. Okay, all right. You get the feeling I really enjoy this, don't you? Yes, because for decades, the life insurance industry has been literally stealing the retirement savings of people's, and they're still doing it. They're still doing it. But you, dear students, will have been given the good news and the good information and won't let them fool you, will you? No. Chapter 10 is entitled Financial Planning with Life Insurance. You can sum up the entire chapter with one line. Buy term and invest the difference. Now, you don't understand what that means, but by the end of this presentation, I certainly am going to do my best to make sure you understand what it means, because it could save you literally tens of thousands of dollars, 100,000 or more, if you follow that wise, sagacious advice from the wealthy barber. But other people have been giving this advice for decades. So the great thing, about the wealthy barber is that he does such a great job of just skewering these people. He's not the only ones. You might have heard of Primerica. Used to be called A.L. Williams. They're one of the big companies that have said, look, you're better off buying term life and we'll help you invest the difference. Okay, but I'll steal a lot from the wealthy barber because he does such a good job of it. Slide number 2. Let's take a look at an introduction to life insurance. Life insurance is obtained by purchasing a policy, with the insurance company promising to pay a lump sum at the time of the policyholder's death. That's how it works, folks. They're not insuring your life. I mean, they're not going to bring you back to life. You crash your car, they give you a new car. Your house burns down, they build you a new house. No, it doesn't work that way. You're dead, and that's it. But the money goes to your heirs. Exactly. You're not buying it for you. You're buying it for your loved ones who depend upon you. However, the insurance company has this don't think of it as just for your heirs. Think of it for yourself, because some policies will pay while the policyholder is still alive if they live long enough. Now, these are the whole life policies. The straight life, the ordinary life, the cash value life, the universal life, the variable life, the universal variable. They have a lot of these things. And these policies are for we shouldn't use the word stupid people. They're uninformed. They've been sold life insurance. They didn't buy life insurance. We'll take a look. There's a slide where we talk about life insurance is sold, not bought. That's a saying in the industry, folks. They're not going to tell you that. The agents are going to say, "Hey, we sell life insurance." They don't buy it. We tell them what to buy, and they buy whole because it makes us. I'm getting ahead of myself. Let's continue. So when you see the word uninformed, you know what to put in its place. Yeah, exactly. Slide number 3. The purpose of life insurance is to protect someone who depends on you from financial loss related to your death. That should be the only reason you buy life insurance, folks. But there are some other reasons: to make a charitable bequest, to leave as part of your estate, to avoid estate taxes. Careful! The IRS looks unfavorably at some of these tactics, which only affect the very wealthy people, individuals who have more than $5.5 million or so dollars, and married couples with twice that amount. And why is that number? We'll see that when we get to chapter 14, why that number is. Also, they will also tell you that you're saving money for retirement or children's education. These are the whole life policies for uninformed, stupid people. Yes, okay. Slide number 4. Here's David Chilton and the Wealthy Barber saying it succinctly in just a few sentences. People should buy life insurance so that when they die prematurely, we hope, you hope to die much later than you'll even need it, but when they die, their assets combined with their insurance proceeds can allow for the proper winding down of their financial affairs and provide the desired standard of living for their dependents if they have dependents. Really, life insurance is better termed financial protection for dependents or income replacement insurance. I like the first. Financial protection for dependents. You're not buying it for you. You're buying it for anyone who is dependent upon you for their financial well-being. Indeed. Slide number 5. How does it work? Well, the insurance companies are geniuses, folks. They may be evil, but they're very smart. And they are very good with statistics. Statistics. The name for the statistician who works at an insurance company is called an actuary. And they build these huge, comprehensive mortality tables. They're like the Census Bureau, folks. They keep track of the demographics. They keep track of people, the information about people. And the mortality tables provide odds on your dying based on your age and sex, and where you live, and how much money you make, and what your financial position is, and what you do for a living. You give them your information, and they will tell you, and it's very scarily accurate, how long you're going to live. In fact, in the face-to-face class, we play the longevity game. This is just one of them out there, but it's actually pretty cute. So go ahead, click on that, and play the longevity game. Your premium is, some of the questions are a little personal, folks, so don't do it if you're in front of somebody you don't want to know your lifestyle. Your premium is based on your life expectancy and the projections for the payouts for the persons who do die prematurely. Because we know someone's going to die in an accident, someone's going to get cancer, whatever. You are essentially betting the insurance company that you will die. Great, isn't it a great bet? Prematurely. We know everybody's going to die, but you're betting that you're going to die prematurely. It's a bet that you hope you lose. And so does the insurance company, because then they don't have to pay. Assuming you buy term life, which is the only type of insurance that you should even consider. Slide number 6. There are 2 types of life insurance companies, and the book plays this up, and we don't really need to know this, but I'm going to ask you to learn it only because of this one little gotcha that can be in your favor or maybe not. And that's called non-participating versus participating life insurance. Stock life insurance companies are by far the largest number of companies or stock, and they sell what's called non-participating policies. So they tell you your premium is going to be $600 a year. Okay, fine, whatever that is, $50 a month. And it stays the same no matter what happens. And no matter what happens, folks. And those of you who are really into research, if you go to the American Council of Life Insurance website, acli.org, you can plow through unbelievable amounts of statistics. The other type on slide number 7 are mutual life insurance companies, and these are disappearing. They're either merging or being bought or turning into stock life insurance companies. I'm not sure exactly all the reasons why. I read something a little while ago, actually a few years ago, and I don't remember why, but I think it's more flexible for them. You are a part owner of the company when you are a policyholder. And notice that there's only 13%, and just a few years ago it was more like 25%. So they're definitely on the decline. And they sell participating policies. Notice that only 27% of all policies in 2014, the last, the fact book comes out in November, right? So for 2015, it'll be the 2016 fact book. For the 2015 data will come out the end of November of 2016. So what is different about participating policies? Well, they tell you, you know what, we're going to charge you $600 a year, like the other people. But hey, we'll get, let's say maybe $800. They'll charge you more, right? But we're only going to actually charge you this year $250 or $225. Wait a minute, what are you doing? Well, we're giving you a policy dividend. That's not a dividend in the real sense of the word. They're not taxable. They're really just a refund. And that's what the IRS hears the word dividend and their eyes light up. Oh, get that. No. They're just not charging you what they said they were going to charge you. We'll charge you $800, but no. This year, because our demographics have worked in our favor, meaning it's a fancy way of saying not a whole lot of people died, we'll only charge you $250. You see? And then they can, next year, if things go well, they can even charge you less, or maybe they can charge you more. They change it from year to year depending on how well the population of policyholders does. If you're in a great group, like teachers who live the longest, they live very long, and that's because we give our stress to other students. We give our stress to the students. Anyway, then your policy premium may go down. But they reserve the right to bring it all the way back up to the stated amount, the $800 a month, in case Ebola becomes all the rage or there's a meteorite or some catastrophe happens. They can turn around and charge you the full amount. So you're participating in the risk. All the things being equal, you'd rather have a non-participating policy because you know how much you're going to pay every year. But there are some exceptions. Some companies have had these participating policies, and they've gone down year after year after year because the population that you belong to has done well. And so that might be a good deal for you. So you should really know the difference, and a good life insurance agent will explain the difference between the two. Slide number 8. How do you know if you need life insurance? Well, it's actually very, very simple, folks. Ask yourself, are there any people who depend upon your income for their living expenses? Does anybody depend upon me to live financially? And if the answer is yes, it's not a question of whether or not you need life insurance, it's how much you need. I mean, there's a few instances where people are, have inherited a lot of money, or maybe they've made a lot of money, and if they passed away, their heirs would be fine. But that's the exception, not the norm. If the answer is no, then you do not need life insurance. It is that simple. If nobody depends upon you for their financial well-being, you do not need life insurance. Now, guess what? Right, you're a life insurance agent. Everybody needs life insurance. Right? I'm a life insurance agent, right? I don't believe that. I would not tell that to people. The life insurance agents convince themselves that they're actually doing people a good job by selling them things that they don't need. So because they got to make their mortgage payment and their orthodontia and the car payment. But no matter what the life insurance agent says, dear students, if no one depends upon you for your financial well-being, you do not need life insurance. Slide number 9. But even if you're single, you have no intentions of ever having kids, you will be told by an insurance agent, of course you need life insurance. Your policy is acting as a savings vehicle. Insurance is cheaper when you are younger, and you should buy insurance now while you are healthy and can still get it. And your response to each of these should be nonsense, nonsense, nonsense. These savings vehicles, those are the whole life, cash value life, straight life, ordinary life, universal life, variable universal life. Those are the policies that have awful rates of return. Now, there may be one or two exceptions out there. People will scream and holler, look at this one, look at this. No, but most of them are horrible. Sure, it's cheaper when you're younger, but why buy something you don't need just because it's cheaper? Does that make any sense? That goes back to chapter 6. It's on sale. Think of how much I'll save. And then the last one, there's a grain of truth to the last one. Only 2% of people are turned down, though. And these are people who should have known better. They had the children were 2 and 4. Someone said, you know what, you really need to think about life insurance. They said, no big deal. And then 8 years later, the children are now 10 and 12. And one of the parents comes down with hepatitis C or cancer or whatever. And now you think any insurance company's going to... No, they're not going to sell you insurance now. So if you do the things you're supposed to do, you're married, you have kids, or maybe you're not married, but you have... Mostly people have kids. But there are some exceptions, as we'll take a look at. So don't fall for this, for these things. And when you have a child, that piece of information gets tucked away in several databases. One of them, or many of them, are from insurance companies. So they're going to send you this thing. Won't you like it? Life insurance for your child. And oh my goodness, when the child turns 18, you can use it for education. It'll be enough to buy one book. Do not ever buy life insurance for a child. Ask yourself a question. Would you be devastated emotionally if your child dies? Yeah, you would be. You'd be distraught. You'd ask people whose the children have died. It's very difficult. Would you be devastated financially if your child dies? No. I know it's a horrible thing, but think about it, folks. Excuse me for being callous, but you will be better off financially if your child dies. 200 years ago, 2,000 years ago, 20,000 years ago, children were assets. You sent them out to work in the fields and to clean the chicken up after the chickens and milk the cows. But not anymore. Children are huge expenses. You got orthodontia and quinceañeras, and they want to go to college and they want to be fed, and oh my God, the teenage boys eat so much. So you'll be better off financially if your child dies. I know. Some people say, well, I want to have a great funeral. Fine, have a great funeral. Don't spend $25,000 on a funeral. That's your decision. Don't ever buy life insurance for a child. And they're usually horrible deals. They're, it's only $10 a month. Yeah. How many children die? It's not many, folks. So, yeah, don't do it. Don't do it. Don't do it. But if you have children, exactly. Slide number 11. This is the demographic. These are the people who really need life insurance. Young married couples, single parents with one or more children almost always need life insurance because if they pass away, there's not enough resources for someone to take care of the child. The question for them is not, do we need it, but rather, how much do we need? And the answer to that is more than you think. And we'll discuss how much in just a bit, so hang on with us. So don't forget, on slide number 12, if you're in that what now is the non-traditional, but used to be the traditional family, where daddy goes to work and fondles the secretary and mommy stays home and beats the children and takes Valium. If you're in that leave it to beaver world, then it makes sense to have some insurance on the non-wage earner spouse, because what the stay-at-home mom and what the stay-at-home dad are doing, providing services that cost money. So you have enough to pay off the debts, we'll talk about that later on, and replace the services that the non-wage earner provided. There's a big caveat, folks, a really big caveat. Men usually remarry quickly, especially if they have children. Women, not so fast. Been there, done that. I don't want another bozo around the house that I have to pick up from. And you talk to women who've lost their spouse, and some of them are very distraught, and some of them are happy. My aunt, she wasn't being mean or anything, but I don't know how we got on this subject, but we were just sitting around the table, and she said, I've been so happy since your uncle died. And she wasn't saying it with malice. It was just true. He was a jerk. And so women say, not so fast. I'm actually enjoying this. And here the sociologists will tell you that this is the pecking order, folks. And you're trying to think, what does it mean, Payano? It's very simple. Married men are the happiest people. That's what the sociologists tell us. Psychologists tell us. I never did the study. And single women are the second happiest people. Right. They've been there, done that, no more. Married women are the third. And the most unhappiest people, the least happiest people, are single men. It turns out that married men actually are healthier. They live longer. The single men say, no, it just seems that way. It just seems like they live longer. Do you want to live forever? Yes. Okay, get married. Every day will seem like an eternity. Okay, so that's what you have to watch out for. So you women, if you're the wage earner and the stay-at-home dad is in your family, or either way, even if it's a same-sex couple, if it's the dad that you have to replace the services, you're probably not going to want to get remarried quickly. The women, if it's the father, he is probably going to want to get remarried quickly, right? Okay, that's how it works. Oh, by the way, speaking of same-sex marriage, the old daddy goes to work and fondle, that whole thing where mommy stays home. They're only 19%. Last statistics I've found. In the same-sex world, it's 20% where one of the parents goes to work and the other one stays home. Yeah, I love perception and reality. Take that, Christian, right? Anyway, slide number 13. Some examples. Who needs life insurance? Slide number 13. How about a young married couple with no children? Maybe. Depends on their debts. It depends on if one works and the other one doesn't, but not much. The other person needs to get on with their life and fend for themselves. How about a young married couple with 2 children? Yeah, they need life insurance. We'll talk about how much for how long in a bit. How about a single adult or an unmarried couple? No, single adult. No way. Unmarried couple, it depends. But normally no. How about a single adult who is a partner in a business? Aha! Here's one of those odd situations that you look at and you say, why would they need life insurance? What happens if you have 2 partners running a business and one of them passes away? Now the spouse or the kids or whoever inherits their part of the business, and now the partner says, well, do you want to run the business with me? No way. I want to sell. Who are they going to sell to? The partner might not have the resources to buy them out. So now the partner's income is in jeopardy, right? So often partners will have insurance on each other, so that if one of them passes away, the other one can buy out the heirs. Make sense? Yeah, think about it, folks. Think about it. How about a married couple with children, but both parents are high wage earners? Interesting. Both of them are making buku bucks, making lots of money, and if one of them passed away, the other one could take care of the finances. What if they both pass away? Indeed. Right. There is life insurance called Second to Die. I don't know why it's called that, but it's called that. And it only pays if both parents pass away. Look it up, folks. It's very interesting. It's cheap because how many times does that happen? Car crash, maybe, No. It's very, very rare. So it'll be cheap, and if both parents pass away, then it would pay. How about a middle-aged couple where the children are gone and the house is paid off? You're done, folks. You don't need life insurance anymore. That's why I say to these people who are getting this whole life, but it's going to take care of me old age. You don't need life insurance then. You can do a whole lot better investing on your own. But what happens when that same middle-aged couple is now taking care of one or more of their aged parents? And this is why that long-term care policy that we talked about in chapter 9, is being pushed so hard, because the boomers are seeing their traditionalists, loyalists, matures, their 80s, 90s, they're seeing them live far longer than they ever thought they would, and now some of them are having to take care of their elderly parents. Will the life insurance industry sell you life insurance when you're in your 50s? Yeah, but they'll charge you an arm and a leg for it. So these people are really the ones who are stuck between a rock and a hard place. Slide number 14. How do you estimate your life insurance requirements? Now, these are from the book, The Easy Method, The Dink, The Don Working, The Family. They're all dumb. Forget about them. Slide 14, so we can just cross that slide off. Hey, if you want to play with it, go right ahead. There's some problems in the book if you want to do. But here's the real one. This is what the wealthy barber says. And by the way, this is not easy. You need often somebody to help you, or continue with Business 121, Business 123, and learn about financing and investing more, or just, ask somebody for help. That's what insurance agents, financial planners are supposed to do. Get out your financial statement. You can always call me. I'll be happy to sit down with you. Use your net worth statement to total your debts. Now, you remember the financial statements, right? They're hanging on your refrigerator or somewhere in your desk. That easy to get to so that you can update them when you need to. Use your net worth statement to total your debts and start with at least this much life insurance. Why? Because the surviving spouse, the surviving family will be debt-free. What a relief, right? You have to deal with the death, emotional wreckage and carnage that creates, whatever its reason. Maybe it's sudden because of an accident or cancer where it's just horrible. So you don't have to deal with debts. And then you create a second cash flow statement without the person's income and without the person alive, right? You don't need a second car. Or whatever, you're not buying clothes for them. You don't need another telephone. So you create another cash flow statement without that person's income and without that person's expenses. And this tells you how much income you need to generate. You determine a principal needed to generate that income. And we'll learn more about this later when we get to investments. But that's the tricky part. Okay, I need this much income per month or per year or whatever. How much of a principal do I need? And it's not an exact science, folks. A lot of people will give you different numbers. You take the first amount, the debt, the second amount, the principal, and that should tell you how much life insurance you need. If that seems far too complicated, the rule of thumb is to just take your gross annual salary and multiply it times 7 to 10 times. Multiply it 7 to 10 times. So say $50,000 a year is what your salary is. You need $500,000 of debt. Of life insurance. Yikes! What? I need that much life insurance? How am I ever going to pay? Relax. It turns out that if you're young and decent health, it's dirt cheap. $500,000 is dirt cheap. You can even buy a lot more and it wouldn't be that much more. So stick with us. Slide number 16. Because now we're going to discuss the two types of life insurance. There are basically two types. There's a few others, but here are the two types. Term life insurance, which is the only type of life insurance. Wait a minute, Payana, what the? See, on the board, in the face-to-face class, we write term, and then we write whole on the board, and then go from there and put stuff underneath it. And I say, here are the two types, and wait a minute, term is the only type, and people look at you funny. And I know, and we'll discuss why later on, so stick with us now. But just know that term life is the only type you're ever going to buy. You are ever only going to buy term life insurance because that is the most economical way to build wealth. It is protection for a specified period of time. If you don't pay the premiums, well, the coverage stops. But normally, 20 years is the term that people choose. Now, you might only need 10. You might want 30. 30 is a little much. Why? Because the kids are 2 and 4. And in 20 years, they'll be 22 and 24. It's time for them to fly the coop. And, well, that's not happening, is it? Millennial up until 30, this thing. So maybe you want 30. I don't know. That's going to be more expensive, but 20-year term is typical. There's a renewability option that at the end of the term policy you can renew without having to take a physical, but you forget it because the price is going to go up by a factor of 100 or at least 10 times or 20, 50 times more. Once you're in your late 40s, your 50s, they don't want you anymore, folks. They want young, healthy people who are, raising a family. That's their demographic, their target market. There's also a conversion option that allows you to change your policy from term to whole life without a physical, but you're not going to buy whole life because you are informed. You are not uninformed, stupid enough to buy a whole life policy. And this is our brave hero, yippee, hooray! And I try to get the face-to-face students to yell, yippee, hooray, and they go, yippee. Now here's the other type. Whole life policy, also known as straight life, ordinary, cash value life, adjustable, variable, universal, etc., etc., etc. Why do they keep changing a name? Hang on. We'll say why in a moment. You pay a premium as long as you live. What? Why do you don't need life insurance once you're retired? You don't have any kids. The kids are gone. Amount of premium depends on your age when you start the policy. Well, that makes sense. It provides a death benefit and accumulates a cash value. In other words, there's a savings component that is built into the life insurance policy. You can borrow against the cash value, or what often people do is once they no longer need the life insurance because the kids are grown, they're retired, the house is paid off, they draw it out in retirement. Look carefully at the rate of return your money earns because it is almost always abysmal. You like that word, abysmal? Use it frequently. People will think you're very erudite. That's another good word that means you're smart. Erudite. I'm more eruditer than you. The evil villain! Boo! Yeah, okay. Alright, it's life insurance, folks. It's not that exciting. We got to try to make it a little bit exciting. But these things are horrible, folks. And there might be an exception that proves the norm, but in general, they are terrible, and I'll tell you why over the next few slides. Slide number 18. Every 5 years or 10 years or so, the insurance industry changes the name of whole life insurance. Why? Because eventually consumers get hip to how they are being screwed. To confuse the issue, they just change the name. Hell no, folks, they're not going to stop selling these things because insurance agents make a ton of money, commissions off of them, and insurance companies make a ton of money off of these things. The newest spin is permanent life insurance. That's the newest one. Wouldn't you really rather have permanent whole life insurance instead of just temporary term life insurance? Well, let me ask you. Do you have permanent car insurance? Do you have permanent homeowners insurance? No. Slide number 19. So to review, term life is a life insurance policy without a savings component. If you pay the premiums for 20 years and then don't die, oh well, you lost the bet. And aren't you glad you lost the bet? Because you didn't want to die prematurely. Whole life is that life insurance policy with a savings component. After 20 years, you have enough to go buy a used car at the used car lot. And that's it. What is the big deal, Piano? If the insurance company is offering to provide you with life insurance and a savings plan, why not let them? Why do you have such an axe to grind? Well, slide number 19. Let's see if we can shine a light on the major differences between these two things. If you're a 32-year-old male preferred, meaning you don't smoke, you're in good shape, no HIV, hepatitis B, C, history of diabetes in the family or the like, 20-year term life policy, the kids are 2 and 4, they'll be 22 and 24 when it's over. You'll pay about $20 a month, $250 per year. Which really, folks, is not that much money when you think about what the life insurance company is going to pay you back if you do die in a car crash or get sick or whatever. If you buy that same whole life policy for $500,000, 32-year-old male preferred, you're going to spend about $2,500 to $3,000 a year, or $250 per month. Starting to see any difference yet? I think so. If a company came up to you and said, to save at our institution, you must buy life insurance. You must pay for it, even if you don't need it. We'll take everything you deposited in the first few years for ourselves. In future years, we'll charge you to deposit money into your savings account. You can borrow the money any time, but we'll charge you interest on your money. If you happen to die while this loan is outstanding, we'll decrease the amount we were to pay your beneficiaries by the outstanding amount of the loan. Meaning they deduct that from the money that was supposed to be paid to your beneficiary. If you don't borrow from this account and you do die, we'll pay the beneficiary the face amount of the policy and we'll keep your savings for ourselves. Doesn't that sound like theft? Oh, and finally, by the way, we don't offer the greatest rates of return, usually between 1% and 2%. And this is, again, from the wealthy barber who I said skewers these people in such a great way. Are you starting to see differences now? Insurance companies are regulated by the states, not the feds, the states. For the last 50 years, virtually every insurance commissioner's office in every state has publicly stated that term life insurance is a better deal for consumers than whole life policy. Virtually every consumers group recommends term life insurance over whole life insurance. How about now? Yeah. Buy term and invest the difference. Now do you understand what that original line meant? You're going to pay $20 a month to the insurance company. Pay the $250 in 1 year, just in 1 month. Just pay it off. So you don't have to make the payments because they charge you $1 or $2 a month just to make payments. And then the rest of the month, pay that $250 to yourself. Invest the difference and you will do magnitudes better than if you would stick with the life insurance company. But Mr. Insurance Salesperson will tell you, but with our whole life policy, you get forced savings. Most people don't have the discipline to buy term and invest the difference. Even with the best intentions, they will not do it. Do you realize what they're telling you? What they're saying to you? You're stupid. Don't put money on your own. Give it to us. We'll take care of it. It's nonsense. If you have the discipline to make the payments to the life insurance company, well, surely you have the discipline to make the payments to your own savings or investment plan. Use an automatic contribution plan from your checking account. Oh, yeah, folks. Oh, yeah. Just, see my blood boiling? Yeah, right, exactly. 24. Do you see why we call term life insurance the only type of life insurance? It doesn't matter which type you buy. You are still paying for protection for your dependents in the event of your death. With term life, you are only paying for that protection. But with whole life, you are paying far more for that protection, plus you're getting tapped for an awful savings plan that you might not ever get to use. And lastly, here's the money pitch. If you do invest the difference, invest prudently with an eye toward long-term growth, ignoring the machinations and the breathless commentators on CNBC and on the idiot box. If you do that, by the time you're near retirement, you will not need life insurance anymore. The kids will have grown, the house will be paid, or pretty close. You will be self-insured. Make sense? Buy term, invest the difference. Slide 25. Going to ACLI.org, the American Council of Life Insurers fact booked for 2015, which shows the last data of 2014, we find that in 2014 there were 5.8 million whole life policies sold and only 3.5 million term policies sold. 61% were whole life and 39% were term. Now you guess why this is. Have you guessed yet? Right. Remember that the $20 a month versus $250 a month? If you're a term life insurance salesman, you're going to make about $70, $80 the first year selling that term life policy. Yeah, well, it's not bad. And then next year it goes down and down and down, and it goes down every year. If you sell that whole life policy, that first year you're going to make $1,500. So, right, which one are you incentivized to sell? You, as a salesperson, are incentivized to sell the whole life policy. And sure enough, that's what happens. And you listen to these people, and they have convinced themselves, because remember, I'm one of them, and I talk to them. They have convinced themselves that they are absolutely doing the best thing for the clients. It's a bunch of hogwash. And when I get into arguments, which I often haven't done in a while, actually I did it last fall. They get pretty angry because you're attacking their cash cow. They get pretty upset, and they've convinced themselves. But slide number 26 shows you something completely different. In 2014, even though the bulk of the policies that were sold were whole life policies, the amount of insurance, the dollar amount of insurance of whole life was only 30%. $471 billion of life insurance issued. That's the dollar amount. You multiply the number of policies times the face value of the policy. And in the term life world, even though only 3.5 million were sold, it amounts to 70% of the insurance issued, or $1.1 trillion, over twice as much. And you go, huh? I do not understand. How can the number of whole life policies be far greater than the number of term life policies, but the amount of insurance in force for term life is far greater? How could that be? Well, it's easy. The number of whole life policies is greater because life insurance salespeople are incentivized, they're motivated to sell you a whole life policy. But the term life is far less expensive. So people who buy term can buy how much they really need. Here's the dynamic. Let's read together. So after the insurance agent convinces the poor slob that she needs whole life insurance, the agent sells her far less insurance than she really needs because the poor slob cannot afford to pay the huge premiums for the amount of whole life insurance her family needs. She needs $500,000, but she can't afford $250 a month. So this jerk sells her $100,000 for $80 a month or $100 a month. She can afford that. But that's not what she needs. She needs $500,000. And if I were king of the world, dictator, benevolent dictator, which I'm not, I would make this criminal behavior. That salesperson should go to jail. Literally go to jail. Because it's like a doctor saying, you know what? You're going to die if you don't take this medicine, but you really should take this much. But you know what? You can't afford this much. Or take this much. It's not going to help you if you die, but whatever. What happens if, hopefully she doesn't die, right? Hopefully she doesn't die prematurely. If she does die prematurely, her whole family suffers. And she won't even know because she's dead. You see why my blood gets, my Italian blood boils? Because this is important stuff, folks. Insurance, life insurance is very important. Hopefully you'll never need it. You buy it. I mean, you'll never use it. You'll need it. You buy it. And then the kids will be grown and you wave them goodbye. And then the term life policy expires. And congratulations. You lost the bet. You're alive. And this in the face-to-face class is where we would take a look at this whole life illustration. This is a real whole life policy where this gentleman was paying $60 a month for $50,000 of a life insurance that in 30 years would give him $17,000, enough to buy a new Honda Fit, or Toyota Yaris, or Chevy Cruze, or a nice used car, but there's your retirement, but it's gone. And the kicker, the guy didn't even have kids. He was single when he was sold it. But that insurance agent convinced themselves that he needed that. See what you're up against? Slide number 28. We've talked about just the two major types, the whole life and the term life. And then there are a few others like group life, which is always term life. And it's usually provided by an employer or a professional association. It's usually a good deal. Sometimes it's free because we work at Southwestern. They give us, I think it's $50,000. I'm not sure. Maybe it's only 25. But anyway, it's free. What the hell? Often banks, credit unions will give you $3,000 worth of life insurance. Well, what's going on? The company goes to the bank or the credit union and says, hey, we'll offer all your members, your clients, a $1,000 life insurance policy. If we'll wash your back, you wash our back, give us their contact information, and we'll say that on your behalf, we are soliciting you. We're giving you $1,000, and here, do you want more? It's usually not a very good deal. So I take the $1,000 or whatever it is through Mission Federal and say thank you very much. Credit life insurance is a horrible deal. And we talked about this in Chapter 5. The mortgage, the car, the furniture, maybe the mortgage, but get term life, it's a better deal. Credit cards? What? You're going to get an insurance policy to pay off the credit cards? It protects the lenders. Why would you protect the lenders? It's very expensive, and who do you care? You die with a lot of credit card debt. Ha ha ha! Nuts. But people buy it. Accidental death, or sometimes called double indemnity. If you die, it doubles the amount. Look, folks, do you care how a person dies? If they're dead, they're dead. But accidental death only pays if the person dies from an accident. And they'll tell you, well, it's cheap, but it's not worth it. Can you imagine the conversation? You get a phone call. Is he dead? Oh my goodness, how sad. How did he die? Oh good. He died in a hang gliding accident. Don't buy it. Even if they say, it's cheap. Good. It's not what you need. You need something that pays no matter how the person dies. Slide number 29. The contract provisions. And these are things that you really should know, especially when you're signing the darn thing, and they're described in the book, so let's go through them very quickly. Make sure you name your beneficiary and contingent beneficiaries. That's the secondary if the first one dies before your first ones. Update it when necessary. Just because you get divorced, a jerk, doesn't mean the life insurance policy that beneficiary has changed. So make sure you change that person on the policy. If you commit suicide within the first 2 years, they will not pay you the face amount. They'll refund the principal. The premium. I'm sorry, not the principal, the premium. And why is this? Because if you're committing suicide to make money, some people might say, oh, I failed my family. I'll get $1 million life insurance policy and commit suicide. Sorry. After 2 years, okay, you've gotten sick. By the way, the psychiatrists say if you're contemplating suicide, you're mentally ill. So, yeah. If you lie about your age, the same deal. They will pay back the premiums. They will not pay the face value. If you're very ill, and I think 2 doctors say that you have 6 months to live, or whatever it is, 3, 6, 9 months, then you can accelerate the benefits. They will pay you while you're alive, which can give people some dignity, right? Makes sense. One of the cool things is most of them have a waiver of premium if there's disability. So you get disabled, they say, okay, we'll waive the premium, which that's a nice thing. Thank you very much. The loan provision, again, is the whole life policy for uninformed people. This one I love, right? If you stop making the premium payments and you have cash value in your whole life policy, they will start rating the cash value to keep the life insurance in force. Isn't that nice of them? Oh, you don't want to lose your life insurance, do you? Oh, you jerks. And then because some people don't like the idea that after 20 years I've lost all that money. Well, the same thing is true with your car insurance if you never have an accident, or your homeowner's insurance if it doesn't burn down. But they have these return of principal for term life policies, and really they're just like sort of a mini whole life policy. They're charging you far more than what you would pay if you didn't have this return of principal. And what they do is they invest it, and at the end of the 20 years, if you did not pass away, they'll give you all your premiums. Well, all they're doing is charging you a whole lot more and investing it, and they're doing their statistics and their predictions and their actuarial calculations, and they're saying, we'll have enough to pay them back their premiums. I don't think it's a good idea, but you decide. Slide number 30. Choosing your life insurance agent. As we said, there's a saying in the industry, life insurance is sold, not bought. Get a good referral. Is the person willing to take the time to answer your questions and find a policy that is right for you? Are they available when needed? Do they ask about your financial plan? Do you feel pressured? More importantly, are they still trying to sell you whole life when you've already told them 3 times that you want term life insurance? Kick them in the butt as you shove them out the door. Oh, excuse me. Oh, I'm sorry. Oh, I feel so much better now. But yeah, folks, find somebody you trust. I have the name of good people that I can give you referrals to. They will steer you right. And by the way, I've only sold 2 insurance policies in my life. I just don't have the time. I just don't have the time. When I got the insurance agent license, I thought, oh, this is great. This will complement the stockbroking part-time that I do to keep, because I teach it and I do it and I love both. I love teaching and I love doing it. And I just found out, you know what? You don't have time, Payano. You really don't have time. And my wife wants to. Yeah, so we won't go there. Slide number 31. Obtaining and examining a policy. The first step is to apply. They're going to take your blood. They're going to get you on the treadmill, weigh you, look into your family history. They're going to check out the MIB, Medical Information Bureau. Exactly. Because they don't want to get, you got HIV. They're not going to sell you a life insurance policy. After you buy it, you have 10 days to change your mind. And why is this? Because of the whole life policies. People would complain after they had these things for 17 years and realized someone finally told them, you're being screwed. So they go to their elected bozos. I'm sorry, their elected Congress people and their state representatives and their state senators and say, this is horrible. And they say, you're absolutely right. So they pass this rule, because the insurance company's not going to let them get rid of whole life policies. They pass this rule that it's okay to continue to sell these things, but we'll allow people 10 days to change their mind. That's how it works, folks. I know democracy might be the absolute worst form of government ever devised, except for all the others. That's Winston Churchill, by the way. Give your beneficiaries and your lawyer a photocopy so everybody knows what's going on. Yes. Slide number 32. How do we pay the money out? Well, there are options. Why? Because the insurance company doesn't want to pay you $500,000. Not you. They want to pay they don't want to pay your beneficiaries $500,000. They want you to they want you to choose a different option. Well, the lump sum is the most common, almost always the best choice, folks. Assuming you're not the beneficiaries going to squander the money. Assuming you have a good financial planner, or you're good at investing and taking care of your nest egg, which some people are not good at, which is why some people say, well, you're just recommending a financial advisor because you are one. No, it's not because of that. It's because some people just really should not be given $800,000 or $500,000 because it'll disappear in 2 years. The insurance company is going to want you to choose one of these others. They're going to want you to do a limited installment payment. We'll pay you $50,000 a year for the next 10 years. How's that? Or we'll pay you a certain amount of money for the rest of your life. Doesn't that sound tempting? Hang on a minute, folks. Or, hey, we're life insurance companies. We're the invisible bankers. That's what they're often called. You can leave the proceeds with us and we'll pay you interest. Slide number 33. No matter what the life insurance company says, take the lump sum, invest it. If you need help, find a good financial advisor. Leave a letter of instruction if you're the insured. You can actually write into the policy that you want the lump sum benefit to be paid to your beneficiaries. At least I was able to in mine many years ago. By the end of this class, you will have a rudimentary knowledge of investments that will give you a rate of return that is at least 2 to 5 times better than anything the life insurance company will offer you. Even if they come after you with these indexed annuity stuff. We'll talk about those when we get to annuities. The life insurance companies love to prey upon the surviving spouse. Folks, this is their business. They know the drill. Put their arm around little lady, because it's often the little lady who's been told she doesn't know anything about finances and she knows a lot more than the jerk who just died. We'll give you an income for the rest of your life, as she's sniffling, and we'll screw you for the rest of your... They don't tell her that part. Because this is what they do, folks. I'm sorry, we're going to switch policies first. I'm sorry, switch policies. My apologies. We're on slide 34. We're going to do the annuity thing in a bit. Should you switch policies? Well, if it's a term life policy and you get a much better deal, which is hard to believe because the deals right now are phenomenal, as we'll see when we look it up on the whole life policy. I mean, the lifeinsure.com, life insurance policy quotes. Which it's another presentation. We would do it in class, in the face-to-face, but you'll do it on your own. Go ahead. But don't cancel the old policy until you've made the payments to the new policy and they've cashed the check and everything's cool. Because if all of a sudden you cancel the one policy and apply for the other policy, the new one, which is a lot cheaper, and it comes back and you have hepatitis B, exactly, you're screwed. But normally, the only reason people switch whole life policies is because a life insurance salesperson convinced them to switch. Why do they want them to switch? Well, if they were uninformed enough to buy a whole life policy in the first place, they're probably still uninformed, stupid enough to switch to another policy. And the salesperson gets a ton of new commissions. Several years ago, a few insurance companies, we won't name any names, Prudential, got into hot water for pushing elderly folks. Elderly folks! How could you take advantage of these people? They have been overpaying for years, and now you're going to get them to switch? Well, they were stupid and just switch policies. Almost done, folks, because now we got to take a look at annuities. The book throws annuities into the end of this chapter. Why? Because that's what they'll try to sell the beneficiaries. They don't want to give out the money, folks. They don't want to pay $500,000, would you? They want to pay that over decades. And so what they try to do is they try to get them to sign up for an annuity. Really, annuities belong in the next chapter when we get to investing. And we'll revisit them there. But suffice to say that they are usually a bad idea, more often than not. And so if you're the beneficiary, or if you're consulting with the beneficiary, tell them, take the lump sum, find somebody to help you invest it wisely over the long term. You will do far better than the annuity, in my humble opinion. And of course, the annuity salesman will tell you why I'm all wet. So listen to what they have to say, and then believe me. Slide number 36, the bottom line. Now do you understand? Now you see buy term and invest the difference, and you understand what it means, right? If you don't, go back over, listen, and watch this over again. Or call me up or send me an email, because this stuff is really important, folks, as we will see when we compare what that poor slob who was sold that whole life policy and wound up, he canceled it beforehand, but at the end of 30 years would have had $17,551. Okay. So, yeah. And we'll see what $60 a month for 30 years will do with bonds and stocks and as we go along. Because we're ready to start my favorite part of the semester, favorite part of the class, and that is, you got it, investing. You need life insurance? Buy term and invest the difference. See ya!